This lunch, I'm Surabhi Upadhyay, and you've just heard all the big headlines there. There's consolidation that's underway. There's a fair sense of caution as far as markets are concerned, not just here in India, but pretty much around the world. Major indices have been treading water, whether you're looking at the Asian trade or whether you're looking at the European picture. The sense of anticipation ahead of that big Wednesday when we'll hear from the BOJ in the morning and then, of course, from the Fed later in the evening. So right now, that's the picture. We'll pull up some of the nifty losers for you just to get a sense of where the profit taking is evident. A lot of the auto stocks, a couple of bank names under pressure. But now let's move on. After sounding optimistic on Indian banks, rating agencies Moody's is all set to meet finance ministry officials for the annual review of India's sovereign ratings. Mary Diron, Senior Vice President, Sovereign Risk Group at Moody's Investor Service, now joins us. Mary, it's great to have you on the show. Thanks so much for taking out the time. Now, we understand that you will be holding that meeting with finance ministry officials shortly. Is there a case for a ratings upgrade for India this year?
The rating for India is Baa3 with a positive outlook, and that denotes our expectation of positive pressure on the rating over the next year or two. And that really relates to our assessment of the implementation of reforms in the broad term in India, reforms that relate to monetary policy framework and implications for inflation, reforms that relate to the fiscal policy implementation and commitment towards consolidation, as well as the broader reforms in terms of improving the business environment. And so gradually we expect these policy measures to be implemented and to have an impact on the credit profile for India over the medium term. There are also constraints on the rating related to the fiscal outlook with relatively high government debt, as well as banking sector that remains a constraint that we think continues to pose a risk for the government.
Okay, so the sense that one gets is that you're not really looking at a big case for an upgrade, at least this year. What about next year, FY18? Because by then, the GST, the goods and services tax, would have also been implemented. Hopefully, the banking sector will be in less need of capital, and the worst of this NPA issue will be behind us. So would there be a better case for an upgrade then?
On the GST first, we think that the implications, the impact of GST really lies in the medium term, so from 2018 onwards, really, and that the impact for the government's budget will come through streamlining of costs for businesses as well as greater tax compliance. It is really in line and consistent with the objective of fiscal consolidation, and so that's really what we're looking at in general, the effectiveness of policies towards that consolidation. We think that the government debt will remain relatively elevated compared to other sovereigns rated at Baa3, partly because nominal GDP growth is moderate, and that prevents that kind of hampers some of the fiscal consolidation. As far as the banking sector is concerned, we're seeing the assets quality, the bad asset recognition, and that has progressed, and we think that there are, to the extent that there are further bad assets to be recognized, is probably fewer than what has been in the past. What still lies ahead is the resolution of these bad assets, and so in the meantime, the banking sector remains a source of contingent liability for the sovereign.
So, Mary, then, in your opinion, what would you say is perhaps the single biggest constraint for an upgrade? Is it the banking sector issue? Is it fiscal consolidation? And on the other hand, what is the greatest support coming in favor of an upgrade?
So the rating, as we discussed, is Baa3 with a positive outlook, and the positive outlook reflects these multiple reforms and policy measures towards a more stable macroeconomic environment. And that's what we will be continuing to look at, the effectiveness of these reforms, the tangible impact on fiscal consolidation, on growth, on inflation. The constraints are in terms of fiscal accounts, government debt burden that is still elevated, and means that there's less of fiscal space should there be a negative shock for the government to respond to, as well as the banking sector that continues to pose some contingent liability risk for the government.
All right, Mary, thank you so much for joining in. Pleasure talking to you. Well, that's the